48 hours ago, the global financial system crossed a threshold that most investors do not even realize exists. On the surface, the markets are celebrating, but beneath the digital noise, $1.4 trillion in nominal value vanished from the S&P 500 in a single trading session. This was not a standard sell-off, but a systemic liquidity lock that has frozen the very plumbing of global commerce. We are no longer discussing mere market volatility. We are witnessing a structural failure of the mechanics that allow money to move. As the futures markets signal a collapse driven by terminal debt and exhausted credit, the illusion of stability is beginning to evaporate. This is the arrival of Black Sunday, the moment where the debt-based prosperity of the last 2 decades finally runs out of future. When the math stops working, who owns what is left? To understand why a $400–500 trillion system is currently seizing, you have to look at the engine oil of global finance, the repo market. Most people visualize the economy as a series of stock charts or consumer spending reports. But the reality is more mechanical. At the center of this machine sits the reverse repo facility. Think of it not as a complex financial instrument, but as the final safety net of the banking world, the last place where excess cash goes to sleep when there is nowhere else safe to put it. For 2 years, this facility was overflowing with trillions of dollars, acting as a massive buffer for the global financial plumbing. But as of this week, that reservoir has drained to near zero. The safety net is gone, and the floor below is made of concrete. The disappearance of this liquidity is not an accident. It is a signal of a profound credit freeze. When the repo markets dry up, the banks stop lending to each other because they no longer trust the collateral being offered. We are currently seeing the euro-dollar market, the vast, unregulated ocean of dollars held outside the United States, enter a state of acute stress. Cross-currency basis swaps are blowing out, which is a technical way of saying that the world has suddenly realized it is desperately short on US dollars. This isn't a problem of physical currency, it is a problem of trust. In the high-velocity world of institutional finance, if you cannot swap your assets for cash in milliseconds, you are technically insolvent. There is a cold irony in the contrast between the private reality of the banks and the public narrative on your television screen. While pundits spend their afternoons debating the probability of a soft landing or a minor interest rate adjustment, the banks themselves are quietly hoarding cash with a desperation not seen since the autumn of 1929. They are moving their capital into the deepest, darkest corners of their balance sheets, bracing for an impact they know is coming. It is a peculiar sight, a system built on the promise of infinite growth, where the architects are the first ones to grab the fire extinguishers. If the world's largest financial institutions, with their armies of analysts and proprietary data, no longer trust each other enough to lend for a single night, why exactly would they continue to lend to you? The freeze starts at the top, but it never stays there. The engine oil has run dry, and the gears are beginning to grind against each other. Without the constant flow of short-term credit to lubricate the system, the massive mountain of debt we have constructed over the last 30 years is no longer a source of wealth. It is beginning to wobble. Imagine a ledger where the ink never dries because the numbers are growing faster than the hand can write. The United States national debt has surpassed $38.4 trillion, a figure so astronomical that it ceases to be a statistic and becomes a law of nature. To the casual observer, it is just a headline, but the forensic reality is far more chilling. For the first time in modern history, the annual interest expense on this debt has officially crossed the $1 trillion mark, eclipsing the entire national defense budget. We are no longer paying for the future, we are barely surviving the cost of the past. This is the point of terminal velocity. In the world of physics, terminal velocity is the speed at which a falling object no longer accelerates, because the air resistance is equal to the force of gravity. In finance, it is the moment of the fiscal death spiral. It occurs when the Treasury is forced to issue new debt for the sole purpose of paying interest on the debt that already exists. There is no productive investment, no infrastructure, and no growth. Only the desperate maintenance of a mountain that is starting to slide. The Treasury market, once the bedrock of global stability, has transitioned from being the safe harbor to being the primary source of systemic risk. There is a dry professional irony in how we label these assets. Financial textbooks still refer to the yield on U.S. Treasuries as the risk-free rate, a term used to calibrate the value of every other asset on the planet. Yet as the debt hits terminal velocity, the market is quietly rejecting the label. Investors are now demanding an inflation premium, extra compensation, just for the privilege of holding government promises. When the world begins to price risk into the very thing that is supposed to be risk-free, the entire valuation model of Western civilization begins to fracture. Let that math sit in the room for a moment. If the interest on the debt cannot be covered by tax revenue, and the only solution is to print more currency to pay the interest, the currency itself is no longer a store of value. It is a countdown. The United States is not facing a potential crisis. It is operating in a state of mathematical insolvency. The gravity of the mean reversion is no longer a theory. It is a force pulling at the fabric of every bank account and retirement fund. But if the foundation of the global economy is rotting, wait until you see the computerized casino we have built on top of it. In the sterile environment of high-frequency trading, there is a technical phenomenon known as the gamma flip. It sounds like a complex mathematical variable, but in reality, it is the engine of market destruction. When the market hits specific price levels where large concentrations of options sit, Market makers are forced to sell billions of dollars in futures to hedge their risk. This mechanical selling does not care about corporate earnings, national debt, or long-term growth. It is a cold, mathematical reflex that turns a bad day into a historical collapse. Beneath the surface of the traditional stock market lies a dark mountain of derivatives, with a notional value estimated between $600 trillion and over $500 trillion. Today, algorithmic trading bots control 80% of daily volume. These machines are programmed with a singular binary logic. If the VIX index or the fear gauge crosses the threshold of 35, they hit the sell button on everything simultaneously. This creates a feedback loop of selling, a digital domino effect where machines respond to the actions of other machines. No human trader can intervene. The speed of the decline is faster than the speed of human thought. There is a detached irony in the success of modern financial engineering. For decades, Wall Street sought to build algorithms that would remove human emotion, fear, and greed from the trading process. They succeeded perfectly. The bots will now crash the global financial system without feeling a single ounce of panic. They are simply executing lines of code that dictate de-risking at any cost, regardless of whether that cost is the destruction of an entire generation's retirement savings. The efficiency we once praised has become the very mechanism of our liquidation. Consider the reality of a zero liquidity environment. In a flash crash, the bids simply disappear from the order book as the algorithms go into error mode. In those moments, there is no one on the other side of the trade. The screen shows a price, but there is no exit. You are witnessing systemic failure, where the mathematical models used by every major bank simply stop working because they never accounted for a world where nobody wants to buy. But while the bots are programmed to die with the system, the architects are quietly finding the exit. While the digital engines prepare for a synchronized collapse, the most experienced hands in the room have already moved to the sidelines. Observe Warren Buffett. For decades, he was the face of the buy-and-hold American dream. But as we enter 2026, his actions speak of a different reality. Berkshire Hathaway has accumulated a record-breaking $382 billion in cash. This is no longer a value investing strategy. It is a bunker. Buffett isn't waiting for a bargain. He is waiting for a systemic reset. Knowing that in a liquidity lock, cash is the only weapon that allows you to buy generational assets for pennies on the dollar. He has effectively handed over the reins at the exact moment the valuation bubble is set to burst, leaving the retail crowd to hold the bag. The forensic audit of the markets reveals a disturbing divergence. The smart money is fleeing while the public is being encouraged to dive in. Corporate insiders are currently selling their own shares at a ratio of 12-1 compared to retail buyers. Michael Burry, the man who famously shorted the 2008 subprime crisis, has taken a massive position against the artificial intelligence bubble, betting against the collateral value of the entire system. He understands that when collateral is revealed to be over-leveraged by a factor of 30-1, the subsequent margin calls will be catastrophic. These titans are not betting against technology, they are betting against the mathematical impossibility of the current price levels. There is a cold irony in the financial advice fed to the masses. Every weekend, major networks feature experts who insist that time in the market is more important than timing the market. They encourage the middle class to keep their 401ks fully allocated in index funds that are 30% concentrated in just 5 stocks. It is a comforting narrative. Yet those same experts are timing their own exits with surgical precision. They are selling their winners to the very people they've spent years training to buy the dip, effectively making the retail investor the last one in the pool before the water is drained. Take a moment to look at the balance. On one side, you have the most successful investor in history sitting on a mountain of cash, waiting for the funeral bells to ring. On the other, you have millions of retirement accounts auto-investing into a bubble that has already reached its biological limit of debt. The exit is a narrow door, and the smart money has been walking through it for 24 consecutive months. They are leaving because they recognize a butterfly effect that most Western investors are ignoring, a tremor that started in the financial heart of Tokyo. For the better part of a decade, the global financial system has been fueled by a silent liquidity engine, known as the yen carry trade. While most investors were distracted by flashy tech headlines, this mechanical giant was humming in the background, providing the cheap credit that allowed asset prices to defy gravity. It is perhaps the most significant butterfly effect in modern finance, a decision made in a boardroom in Tokyo determining the fate of a retirement fund in Florida. The mechanism is deceptively simple and dangerously effective. For years, the Bank of Japan maintained interest rates at near zero. While the rest of the world saw rates climb, global hedge funds and institutional traders took advantage of this disparity by borrowing trillions in yen for practically nothing, then immediately converting that yen into US dollars to buy high-flying tech stocks like Nvidia, Apple, and Microsoft. This created a constant, artificial bid for American tech, pushing valuations to levels that had no basis in local economic reality. But the era of free money from the East is over. As the Bank of Japan is finally forced to raise interest rates to protect its own currency, the cost of maintaining those yen-denominated loans has skyrocketed. This has triggered a forced repatriation of capital. To pay back the now expensive yen they borrowed, these global funds must sell their US tech holdings, and they must do it quickly. When you see names like Microsoft or Apple dropping 5% in pre-market trading, you are not seeing a change in their business model, you are seeing the carry trade unwinding in real time. It is an orderly exit that is rapidly devolving into a stampede. There is a dry, almost poetic irony in the foundation of the AI revolution. We were told that the meteoric rise of Silicon Valley was a testament to American innovation in the dawn of a new supercycle of productivity. In reality, a significant portion of that innovation was funded by the modest savings and pension accounts of Japanese citizens who were simply looking for a way to escape 0% interest rates at home. The future of artificial intelligence was, in many ways, subsidized by the past of a demographic that is now calling the loan. The cheap money spigot that lubricated every corner of the global market has been turned off, and the silence is deafening. In a world built on the assumption that money is free, the sudden arrival of a cost for that money acts as a universal solvent. The artificial demand is evaporated, leaving the most popular stocks in the world exposed to the harsh reality of their own overvaluation. And as the liquidity tide goes out, it reveals the rot in the real economy that was previously hidden beneath the waves. When you walk through the financial districts of major American cities, the glass towers look as imposing as they did 5 years ago. But behind those polished facades, the industry is surviving on a mantra of desperation: extend and pretend. This isn't just a clever phrase. It is the official strategy for a $2.2 trillion commercial real estate bomb that is currently detonating in slow motion. For years, developers and banks ignored the decaying reality of empty offices and shifting demographics, choosing to push the debt further into the future. Now the future has arrived, and it is demanding payment in a currency the system no longer possesses. The forensic reality is that over $2.2 trillion in debt will mature within the next 18 months. Most of these loans were originally financed at 3%, but they must now be refinanced at 8%. A mathematical impossibility for buildings that are half empty. This pressure has ripped $1 trillion hole into the held-to-maturity portfolios of the banking sector. Major regional banks are currently sitting on unrealized losses that are 3 times larger than their total capital buffers. It is a digital bank run waiting for a spark, where money moves at the speed of a swipe. This rot extends far beyond real estate and into the very heart of the corporate world. Today, over 20% of the companies in the S&P 1500 are officially zombies, entities whose profits are insufficient to even cover the interest payments on their existing debt. They only continue to exist because they had access to 0% interest rates for over a decade. Now that the cost of money has become real, these companies are effectively dead men walking, waiting for the credit windows to slam shut. There is a cold, gritty irony in the way we have managed this decay. Capitalism without the possibility of bankruptcy is like Catholicism without the concept of hell. It removes the only mechanism that keeps the system honest. We have spent 15 years subsidizing failure and calling it stability, creating a landscape filled with financial ghosts that cannot produce, cannot grow, and cannot survive without a constant transfusion of new debt. By preventing the small fires of creative destruction, we have ensured that the coming blaze will be an extinction-level event for the corporate sector. Look closely at the numbers, and the illusion of the robust consumer evaporates. Credit card delinquencies are at a 15-year high, the savings rate has hit a terminal floor, and a new generation is drowning in buy now, pay later debt that doesn't even show up on traditional balance sheets. The engine of the economy, the American consumer, has finally stalled. In this environment, a default is no longer a risk to be managed. It is a mathematical certainty that the system can no longer absorb, and usually in moments like this, you would expect the Federal Reserve to step in and save us. Not this time. For 3 decades, the market has lived by a single, unshakable article of faith: the Fed put. It is the comforting belief that whenever the gears of Wall Street begin to grind, the Federal Reserve will materialize to print whatever amount of digital currency is necessary to grease the wheels. Investors have been trained like Pavlovian subjects to buy every dip, confident that the central bank wizards always have one more spell in their book. But as we enter the final hours of this debt cycle, that belief is meeting a cold, mathematical reality. The wizard's wand is broken, and the room is starting to get very quiet. The Federal Reserve is currently caught in a policy cul-de-sac with no clean exit. If they cut interest rates to save the regional banks and the commercial real estate market, they effectively surrender the dollar to hyperinflation. If they keep rates high to fight the stubborn fires of inflation, they ensure the total implosion of the very banking system they are sworn to protect. This is the endgame of the Great Debt Experiment. Compounding this internal rot is the death of the petrodollar recycling mechanism. As the BRICS nations move toward commodity-backed settlement systems, the global demand for U.S. treasuries is vanishing, meaning the Fed can no longer export American inflation to the rest of the world. There is a detached forensic irony in our current predicament. The very institution that spent 15 years suppressing volatility and inflating the largest credit bubble in human history is now the only one powerless to stop its collapse. They have used every monetary trick, every verbal intervention, and every balance sheet expansion possible, only to realize that you cannot print your way out of a solvency crisis. The policy toolkit is not just depleted, it is a historical relic in a world that has run out of greater fools. Take a long look at the Federal Reserve's own balance sheet, already bloated with $7 trillion in depreciating assets. They are not the fire department anymore, they are the fuel. The transmission mechanism of money itself is breaking apart at the seams, and for the first time in 90 years there is no bailout coming. The realization is setting in among the institutional elite. that the music hasn't just slowed down, it has stopped, the toolbox is empty, the season of accountability has arrived to collect the debts of the last 2 decades. When the illusion of a stable global financial order evaporates, it leaves behind a reality that cannot be managed by a press release or a repo injection. We are moving toward a world where paper promises are recalculated to their real value, which for many will be a catastrophic discovery. Welcome to the new reality. Black Sunday is not a single date on a calendar. It is the expiration date of a global debt experiment. The era of easy money, fueled by cheap credit and the illusion of infinite growth, has reached its natural conclusion. We are witnessing the death of the 401k myth and the traditional 60/40 portfolio, as the paper promises of the last decade are recalculated to their real value. The transition will be violent for those holding virtual wealth, but it is a necessary cleansing of the rot. We are moving toward a hard asset world where cash flow, tangible productivity, and physical value are the only kings. The speculation is ended, reality has begun, the math is terminal, the debt is due. Tomorrow morning, the opening bell will ring, but for the old world, it is a funeral toll. If you are ready to face the new reality, leave a 1 in the comments. This is Financial Money History.